Welcome, everyone, to the Fiscal Philosophy YouTube channel. Oatly stock has jumped over 34% in the last few days. While I don't personally own shares of Oatly, I think it's important sometimes to cover stocks that I'm not personally invested in, just to give an idea of what goes into the process of making a decision. What's the difference between a buy and a pass, right? What are some green flags and red flags that I look out for that are potential indicators of a thumbs up or a thumbs down on an investment? All that being said, I'm going to get into the financials of Oatly, perhaps look at the valuation if I'm able to come up with one, and some of my potential thoughts about what the possible futures are for Oatly. So let's get right in. Oatly went public, I believe, in 2019. And the thing that gets the market most excited about companies in this stage of development is usually their revenue growth. Now, I will admit, in the early stages back there, like when you look in 2020 and 2021, it looked like they were, while not crazily so, they were consistently growing revenue. However, if you look at the last few quarters, it seems to have really gone flat. And, for me, for a company that's in the stage that they're in right now, that could be potentially a little bit of a red flag. There are, of course, potentially legitimate reasons for revenue to temporarily go flat, and it's not a nail in the coffin, but it doesn't necessarily excite me to see this. Another metric I also like to look at is, of course, the shares outstanding. Basically, if this number is massively going up, it means that they're essentially taking cash directly from investors and using it to fund their operations, or they're doing an obscene amount of share-based compensation or something along those lines. And they have kept this pretty flat as of late, which, I'm glad to see, because at least it means that they're using other things to fund their operations other than just selling shares out on the open market and diluting shareholders. Oftentimes, companies at this stage, you do see them diluting shareholders massively because in a lot of cases that's cheaper for the company than taking on high levels of debt in order to fund operations. You don't have to pay interest on equity after all. So the next thing I want to understand is the gross margins. And honestly, with a company that's got flat revenue, you don't want to see gross margins go from over 30% down to under 20%. Now, granted, they were down further and they've recovered some. Maybe they're still recovering and they'll go back up. But again, if revenue's flat and shares outstanding are flat, really the only thing they can do to really, raise more money at this point is either improve profitability or honestly take out debt. And so this leads me to think maybe there could be a lot of debt here, because these margins and the non-growing revenue for a new company like this, I'm doubtful that they're turning a profit. And now, looking at their net income, we can be sure that they're not simply reinvesting their profits back into the business simply because, well, there are no profits. So they are negative both on a GAAP accounting basis, so net income is negative, and of course, they're also still negative on a free cash flow basis. So it's not just that they're producing excess cash and have some paper deductions. No, they're negative both in terms of generally accepted accounting and cash in, cash out. So they definitely, I mean, I would be shocked if there wasn't debt on this balance sheet. But let's take a look and find out. Going over to that balance sheet, yes, the debt situation's a little wonky here. So total liabilities have jumped to over $850 million dollars. About half of this, about $425 million, is current debt, with another $200 million in long-term debt. Other liabilities make up the rest. That's a pretty scary amount of debt for a company that's burning cash at a pace that makes me wonder how it is they would plan to pay this off, especially since revenue is not growing and margins are down. I also noticed that their SG&A expense seems extremely bloated. All right. For a company that's not even bringing in 200 million a quarter in revenue, for them to spend over 100 million of that on selling, general, and admin seems like just burning money. And if I was a shareholder, I would probably be up in arms about this one. But there is a little bit of potentially good news. They do still have positive book value, which is higher than the current share price. And they do have over $300 million in cash showing on the balance sheet. Although this is somewhat out of date, considering that it's close to their next earnings release. But as of their last earnings, this was true. So it could be that at least if they have some kind of a plan to right the ship on revenue and margins, the cash that they have may at least buy them the time to do that. I'm about to get into analyst estimates. Before I do, make sure you remember, in the name of the moon, to punish that like button, to subscribe, and make sure you throw your tiara at the notification bell. Honestly, this is one where I have a hard time reckoning the analyst estimates with the current price and their projections. So right now, the share price is 62 or 63 cents, I believe, with analysts projecting a low forecast of $2 and a high of $4 over the next 12 months. This does give them a consensus of buy, but since they're not projecting any profitability in the next 2 or 3 years, I don't know how it is they're getting to this price point in the next 12 months. So, valuing a company in the place that Oatly is in is kind of challenging. All right. So, the stock price is 63 cents per share. But again, their earnings and cash flow are deeply negative. So if you try to put them into any kind of DCF calculator, it'll come out with a negative value, which of course you can't pay negative dollars for a company. All right. So the model more or less breaks down here. Now you could potentially argue like, hey, they've got a tangible book value of 71 cents. Their current stock price is 63 cents. I think that that's enough of a, difference there, and they've got enough cash that I think that they can, basically last long enough to become profitable for it to be worth the risk, considering I can pick them up for cheaper than their net asset value. That's a justification. I mean, you could make that justification. You could say, hey, analysts have a forecast of between $2 and $4 in 12 months, which maybe like that could be based partly on technicals or something like that. I really don't know how they're getting there. It's certainly not, I don't think, using a regular DCF calculator like this. But analysts are supposedly experts. Although remember, take them with a huge grain of salt. I don't think it's necessarily wise to dump money into something that's basically burning cash at a ferocious pace, whose liabilities have skyrocketed recently, with low margins and flat revenue. On the say-so of what analysts think, this could be a classic case of just because they've, it's a company that, I mean, honestly, the biggest criticism I get in Oatly videos is I love the people saying to me, hey, I love the product, and that's part of the reason I invest in the business. I never want to go back to regular milk again. They're in Starbucks. They have all these deals, coming through the pipeline with all these other, coffee chains and other businesses, and you just don't see it. And I hope all those deals go through and that things really go well for this company. But on paper, in the actual financials, the dollars and cents, they're not really adding up to a good case for investing. Like, I want you to think, like, if somebody came to you and said, hey, like somebody with like a small business came to you as an individual and said, hey, I want you to invest in my company. And, they said, and I've owned the company since 2019. We've lost money every quarter. Revenue is flat. We have a lot of debt. Are you interested? You would probably laugh at them, okay, if we're being honest. And so Oatly is one of those companies where, like, I look at their financials for a couple minutes and I just sit here and I say, man, There's a lot of uncertainty here. They don't have like a huge long track record. And I just think I can find better opportunities. And I'm not against buying stocks that have fallen a lot recently if I can make sense of the numbers to the point where I can say, okay, the stock's down, but there's a disconnect. They're actually a lot more financially healthy than what it maybe looks like on the surface. And the market is just scared. Those are the instances where I'll buy a stock that's down a lot. This would just be a pass for me. It reminds me a little bit too much, again, of the way the financials looked on, say, Tattooed Chef before they went bankrupt. It's not to say that they have even a bad product. Dairy alternatives are popular in a lot of places, but if buying something just because you love their product was the way to go about investing, I'd be like 50% weighted in Coca-Cola stock because I can't stop drinking Coke Zero. But I actually own zero Coca-Cola stock because I love their product and even think that they're a great business and not going anywhere and all that, it doesn't necessarily make it investable for me, right? For them, it's a valuation thing. For this, it's just like I can't say for sure if they'll be around in 5 years, and that's a concern. So, feel free to, let me know if you disagree, but that's where I'm at with Oatly. Too hard to value for me. Do me a favor, and if you enjoyed the video, please make sure you subscribe and like. Also, drop a comment down below so that it can be buried faster than Tony Montana buries some cockroaches. Also, remember to join us on Discord. Link, of course, is in the description. Have a wonderful day, everybody.